I got a question about the BRICS thing.
Yeah,
What kind of news event could come out of there to drive the market? I don't see anything really earth shattering there.
yeah, I know what you mean. You want to look at how the news, I'm just thinking out loud, look at how the news flow came out of it. Started, as on the upswing. Russia leaks that there's going to be a single currency. Everybody gets hopped up on it. Uh, uh, then China comes out, more or less. Then China comes out and says there's not going to be a single currency. We're working on something. And then Russia comes out and says, various Russian voices come out and say conflicting things. One says there's not going to be a single currency, but we're going to have a way to set, like they're marketing to the BRICS people, but at the same time they're being more careful now after that asinine statement. So the news has gone from ridiculously bullish for gold to a nothing burger, right? That's how it started. So let's say we're trading the news, right? So if it started out as a big thing and now it's a nothing burger, then maybe it's bearish because nothing's going to come out of it, right? Unless you think that they're really Machiavellian, that nothing's going to come out of it and then something will come out of it. All right, let's talk about the fundamentals for a second. Whatever they want to do, they can't do it. Not yet. Okay. They may want to do, it's always three things on me, right? They can do one of three things. One is they can, I'm not saying they're going to, and it's not probability. One, they launch a BRICS coin. Okay. That's the first thing they said. I'm telling you, that's not going to happen. Okay. And even if there were a BRICS coin, it wouldn't be for everyone. It would just be for their trades between each other. It would be like an IOU. There's no BRICS coin coming. Okay.
Like electronic coin?
Well, no, but what I mean is the physical manifest, not literally a coin, but the physical, there's a coin, it's listed on an exchange. No, it's going to be a fucking IOU. Now, I could be wrong. We know I could be wrong about this, but what I'm saying is, and I'll tell you why I feel so strongly about this. To create a coin that links the countries negates the yuan. They don't want to negate the yuan. China's in charge here. If you create a coin, remember, the biggest fight when the euro was created was the death of the Deutschmark. Big deal. Big deal. It's like, that's our national currency. Remember, England didn't join, right? So for the yuan, for China, for this many years, this is all my opinion, for this many years for China to work on solidifying its economy and making it, wholesome, or however you want to look at it, for them to just say, yeah, we'll be partners with Brazil in a coin called BRICS coin. No, your money is your brand. That's why I don't think there's a international BRICS coin. That's number one. Number two, and this is completely doable, theoretically. See, the problem with a BRICS coin is, aside from my bias, is that you're dealing with commodity baskets. You make wheat, I make oil, he makes pistachio nuts. How do we weigh the basket? I don't think they have the skill for that. I don't think they have it. Let's put it this way. They don't have the negotiations done on that. On top of that, they don't have 40 members. They have 40 people who want to join. That's like 40 people at the front door of a nightclub. You haven't let them in. They don't have the money for the cover charge. They're not over 18. They're not qualified. I mean, who's qualified? The 4 people in M-Trade, fucking China, Russia indirectly, India, and Saudi Arabia. And Brazil's not qualified, in my opinion, right? So there you have it. Like, that's who's qualified. Notice on the M-Trade platform, the 4 banks are all geographically near each other. It's very geographic. So what I'm saying is just because you got 40 people who want to buy the new Air Jordans doesn't mean you're going to have more than 2 of them who buy them or be permitted to buy them. So 40 people applying means nothing. It's the same old thing as oversubscribed IPO. It's the same bullshit. That doesn't mean they're not going to be there, but it means right now you need to make sure that anybody you let on this platform, they've got to have I need to see your financials, Steve. You need to see my financials. We need to be completely transparent with each other. Do you have enough money to do this? Because in mechanisms like this, which are basically collateralized risk, collateralized debt obligations. There's another word for it. I can't remember. I used to. Basically, you're pooling risk. When you pool risk in bonds, they used to talk about it in tranches, right? During the CDOs, tranches. There's AAA and there's CCC, right? And you may be an average of BBB, but AAA has to pay CCC's losses. So if you've got two countries, China and Botswana, and these two countries are on this platform, it's only as strong, not as the average, as the weakest country. There's a weak link in these things. Everyone, I know this from my exchange experience, everyone has to be up to snuff, or the exchange, the senior people end up subsidizing the junior people. So my long spiel short is 40 people may be applying, but 40 people ain't going to be accepted, because that's just how it works. Number two, 40 people, even if they're accepted, it takes time. You're creating a network. I mean, you need market makers. You need someone who's going to be on that platform all day. And it's probably going to be China and Russia doing their deals, right? So the first thing is BRICS Coin. I don't think it's going to happen. I could eat my hat on that, but I don't think it's going to happen, because that hurts China. China worked too hard to get where they are. And my information is China is the BRICS coin. The yuan is the BRICS coin for them. All right. So you got the BRICS coin. No, that's not going to happen. You got the 40 people joining. That may happen, but it's not going to happen tomorrow. It's not going to happen in 2 days. And the fact that they're toning down the rhetoric means it's probably not going to happen for a while, And then the next one, and this is the one that I believe can happen tomorrow, if it's the most likely and easiest to happen. Whenever you create a new platform, whether it's M-Trade or R-Trade or whatever it's called, Brick Trade, I don't care. Whenever you create a new platform, not new money, whenever you create a new platform, each country wants to trade in their sovereign currency. But only 2, maybe 4 probably can. 4 will reach the requirements. China, Russia, maybe not Russia lately. China, Russia, India, and Saudi Arabia. Let's say those 4 countries, in my opinion, are most qualified. Okay. China and Russia trade with each other. Whoever trades with each other on this platform, they're already trading with each other. So it makes it easier. I'm selling oil to China. China's buying oil from Russia. Saudi Arabia is selling oil to China. See how that works? India is buying oil from Russia. India is selling oil to China. Oil, natural gas, already established trade relationships. Now, the way you do it is you create a trade. This is my opinion, and I'm probably not far off from being right. The way you do it is you take a deal that's going down. Russia is going to sell oil to China. Boom. China is going to pay them in yuan. Okay. Normally, this is what they do. They pay them in yuan, and they get the yuan. Okay. But on the BRICS platform, China will pay them in whatever they sell back to them. Call it dumplings. I don't know. So at the end of the month, it's kind of like this. Between now and the end of the month, China owes Russia 1 million yuan. Russia says, we use gold as a claim on that yuan, and we square up at the end of the month. In the meantime, China sells Russia. It's not going to happen. China sells Russia 900,000 yuan in, let's use dollars, right? $1 million in oil, $900,000 in wheat. So net by the end of the month, there's 100,000 difference. And that 100,000 difference will be settled in gold. It'll be settled in blockchain gold. It'll be settled in yuan with gold implicitly behind it. It'll be settled in NFTs. It'll be settled in a basket of currencies. They can do this. They can do that. And the reason I'm so comfortable saying that is because that's how mercantilism works. Mercantilism means, all the other bullshit aside, mercantilism means nobody borrows. Mercantilism means everything's cash and carry. Mercantilism means you and I, we trade for goods and we settle the difference in something else, which is almost always gold. There's no trade deficit. Okay. There's no, like, we have a trade deficit. We buy everything and we balance it out with our current account deficit. We buy goods from China and then they buy bonds from us. So it's like we buy from them on credit and then they buy the credit. See how that works? In a mercantilistic world, it's like this. You buy, no credit. At the end of the month, you square up. So it's like a business, right? 30 days, we have to square up. There's no running total. There's no, I owe you $5. Let's get it to the next time we play poker. There's none of that. You square up at the end of every sit down when you play poker. And so you need to square up with something. You square up with this is what China and Russia have been doing since 2017. Pay attention, whoever's listening to this. Since 2017, I'm telling you what's been going on because it was told to me, and over the years, it has happened more and more. Russia and China started testing blockchain out in 2017. China bought oil from Russia using a blockchain prototype that allowed China to sell the oil to Russia. I'm sorry, Russia to sell the oil to China and China to pay them in yuan. They paid them in yuan, but the yuan was a special contract. We're paying you in yuan, and in the contract, wasn't the contract that went with the oil deal? Is like, should we not pay you the yuan, or 20% of the yuan is, or 100% of the yuan is convertible to gold. The yuan wasn't convertible. The contract was convertible. And so China then, this is it. I mean, this is what's happened, right? So China says, okay, we owe you 1 billion yuan. And Russia's like, fine, give me the yuan. And China's like, no, we don't want to give you the yuan. Russia's like, well, you know what? Why don't we test this gold blockchain thing out? So China goes, here's the yuan. And with the contract, if you give us 200 million yuan back, we'll give you 200 million yuan in gold. Where's the gold? The gold is in the Shanghai Exchange Vault, okay, with an NFT blockchain attached to it, and Russia has that code. That's what's going on. China and Russia trust each other enough so that China's like this. We're going to pay you in yuan. And Russia's like, well, maybe your currency's not so good. You know, we don't have dollars. Well, you know what? I'll give it to you in gold if you need it. If you want it in gold, I'll give you a warrant. It's like a warrant. I'll give you a warrant on gold. I'll give you a call on gold. And that's what happened back then. And it's been happening. And they cleared in the Seychelles. They cleared in the Seychelles Islands, which are near India. See how that works? It's all fucking tied together. They've been doing this for years. They're ready to go. They've been ready to go. It's just getting the other BRICS to be on board, to understand it, to buy into it, and to be worthy of being on it. Bilateral deals are already happening this way. Now, Russia, remember, China trusts Russia to do the deal. Russia trusts China to pay them. But Russia's not so sure that yuan will survive, because in a world without dollars, Russia needs something to guarantee their money with, or to have to backstop their money. And so China says, let's use gold. I'll store the gold for you. Now, if Russia doesn't trust them, that's a bad deal, right? So there's still trust. Even though there's NFTs and there's blockchain, there's trust there. So what's happening is, if you zoom out, what's happening is the world used the United States to store its gold. And it trusted the United States because after World War II, we were the peacemaker. We were trusted. We earned that trust. And as time went on, starting in 2016, 2017, Germany said, let's take some of our gold back. France, let's take some of our gold back. Venezuela, we want some of our gold. Venezuela couldn't get their gold, right, out of the UK. So what happened was people started being less, it was less necessary to trust the US because either they don't trust the US, which wasn't really the case then, or they were working on something else. So China is now the US. Now, I don't mean that they're the US, but I want you to think of it this way. The world trusted the US after World War II. We earned that trust. China, so far, to the BRICS, to that community, China is trusted by the BRICS. In that little gang over there, they're going to leave their gold. They'll leave their gold with China before they'll leave their gold with the US. And that's what's going to come out of this, Steve. Ideally, for me, what comes out of it is we have a platform. We're going to start doing bilateral trades on it. And as we approve members, we'll do it. That's the best reasonable news I will believe. Everything else is bullshit. The worst reasonable news I believe is we're looking at it. It's not feasible to do for its own currency. They already said that. It's not feasible to do under one currency, at least not yet. They're looking into it, but it's not fucking easy. Like I've done it with other derivatives. You can't do it. You just can't do it. It's very difficult. It's very much an art. And finally, there is one news item, Steve, that people have forgotten about that is a positive, that is expected to come out. And that news item is there's I forget what it's called. They call it the Shanghai Cooperative. Basically, there's another organization of countries, and it's basically it's the Kazakhstan group. It's like the Kazakhstans and a couple other of the former Soviet countries that are very Asian geographically, demographically, and they form their own little trade group, and they're like Friends of Shanghai or something like that. And they're in their own thing. They're not officially a part of the BRICS, but they're supposed to announce, that's supposed to happen. Let me see if I can look it up. The SCO, Shanghai Cooperative, SCO, Shanghai
Cooperation Organization.
Oh, there it is. Yeah, thank you. Who said that? Kevin?
That was me, Thanasis.
Hey, all right, so see this? China, India, Kazakhstan, Kyrgyzstan, Russia, Pakistan, blah, blah, blah. So there's an overlap, obviously, right? But the people that are in that are not in the BRICS are Kazakhstan, Kyrgyzstan, Tajikistan. It's the stands in India, basically, right? So we don't care about China and India. They're already in it. Well, India is arguing for pieces. We don't care about, we only care about, and Russia, we only care about the stands. Kyrgyzstan, that's probably right. Kazakhstan, Kyrgyzstan, Pakistan, Tajikistan, Uzbekistan. That's it. Now, are they big powerhouses? No. But they're another player. They're a good bench player. They're your sixth man, and they're pretty much already there. But there's other people, like here you go, dialogue partners, Afghanistan, Belarus, Iran, Mongolia, right? We don't care about them. Armenia, Azerbaijan, right? I know what that is. Cambodia. See all these countries here? Like we don't care about them. They may be in it, they may not. We care about the stands. And what's absolutely expected to come out of the BRICS, if nothing else, is the Shanghai Cooperative, or the SCO, is supposed to officially partner with whatever it is they're making. If that doesn't happen, Steve, that's really bearish. That means not because of gold or because of the money. That means that within the BRICS, there's infighting. You follow?
I follow.
Thank you. So that's it. So the I'm sorry, go ahead.
Yeah, this is Britt here, but the other thing about the Shanghai Cooperative is if you drew it on the map, it's a corridor for the Belt and Road. initiative,
Oh,
and
is it
it's like
really?
the east-west corridor for commodities, essentially gold, oil, and natural gas from west to east. So it's very important.
Oh, there you go. Okay.
It's
So
a
I guess
very
they probably
important
kept it separate for a
initiative
reason.
to succeed, and it's also China being the mouthpiece instead of Russia on this. So it's like a proxy to get deals done.
That's
So
an
basically
insight.
it's the white area on this map.
Yeah,
Right. So there you go. So there you go. So it's right. Mongolia and China. So Mongolia is when they're, that's a good point. Mongolia is when they're talking to, there you go. So basically it's, well, Mongolia is not going to say no. They're part of China, basically, right? I mean, or they'll get invaded, right? Kyrgyzstan, Kazakhstan, Turkmenistan. So basically, like you said, it's the route from here to Europe to get oil there without Russia. I see your point. Right, right. You know what I think is going to happen? I'm speculating here, but I've talked to Bryn Kelly about this. These guys, they want to supply oil to Europe. That's going to be a big customer. And Europe wants to be supplied. And we don't want them to supply it. So paranoid, but geopolitically accurate. The US wants to make WTI much more important. So oil, now you got me doing this. I want to do this. I'm going to show you something here. All right. Oil here is priced off of an index. Now, some of you may know this, some of you may not. And the index is a weighted index of oil from here, here, and here, and here. So it's when you see the pricings, you'll see like OPEC just priced its oil at this index plus $2. You'll see stuff like that. And the index is a lot of the indexes are managed by Platts, an American company. And what's happened is because of the sanctions, right? You've kind of messed up the indexes. Wait, where's my kind of messed up the indexes? So you've made what's a global commodity more regional. WTI isn't going there, or maybe it is. Russia's not going here, right? We're not buying their oil. You know, China's whatever. The point is that the oil here is staying here. The oil here is staying here, with some of it going to China, right, and Japan, and that's basically it. So what you've done is you've effectively made a global commodity regional. This is a big deal. You've made a globally fungible commodity regional. So check this out. China's saying, or let's say Saudi Arabia, right? Saudi Arabia is saying, you know what, we're not going to price our oil in dollars anymore. We're going to price it in whatever we price it in. And we're going to price it in. So the United States says, fine. What benchmark are you going to use? We'll use the benchmark that has Brent and this and that. And so the US, and this happened. The US lobbied the UK benchmark so that, let's say it's 80% Brent and 20% WTI for their standard. It's now like 70-30. So now there's more WTI going into the benchmark, which means the lower WTI oil, this is why we're selling the oil, guys, aside from the fact that it keeps our demand down, keeps prices down. The more oil that goes into the calculation to determine this oil's price, the basket, the lower their price is to sell. So we're trying to drive down oil prices here by adding a multiplier to our oil contribution here. And why am I bringing that up? Simultaneously, and I'm not exactly sure this, but there's a pipeline that's supposed to go here or here. I'm not sure where it's supposed to go, but this pipeline is supposed to go here, and this pipeline is for natural gas and oil going up. And the reason they're doing that is because they don't want to go around and here. So oil that's from here, Russia, here, they want to go this way. They're not going to go around. And this here, the Suez Canal, the Suez Canal is for oil coming out of here. It goes here, it goes in, it goes through. Well, guess what the US just did with the Suez Canal? Well, the US didn't do it. The Suez Corporation did it. They just raised prices. So tying this all to what you just said, Britt, China and everyone over here wants this route clear to get oil there and natural gas, which is why your Shanghai Corporation is so important. That makes sense. That makes a lot of sense. Thank you. Right. Meanwhile, we want the price of oil down because it breaks Russia. We want to break, even if China benefits, we want to break Russia. That's my thesis. Right. All right. So what do? We get more oil in this basket, which gets more oil in this basket, which drives prices down. And here's the kicker. Then we get, I'm not saying we, this we part I'm making up, the prices on the Suez go up. The prices on the Suez keep going up. Then the Saudis have to go either around or landlocked up through. So the point is, it's in the U.S.'s interest, going to sound crazy to say, but in light of what happened recently, I'm talking to you geopolitically now, it's in the U.S.'s interest to blow this up tomorrow. That's it. If the U.S.
Turkey and
blows this
Ukraine.
up, I'm sorry, what?
Turkey and Ukraine are the choke points. Because that's where
Yeah, that's the natural, right? All the natural gas coming into Europe goes like this, I think, right?
And there's Qatar would like to use Turkey as its natural gas line. So Turkey is really the linchpin to getting anything into Europe, the European market, rather than instead of LNG, because LNG is going to cost more. So a pipeline. Turkey's in the driver's seat with the whole East-West relationship.
Yep.
Right. So it's basically it's Istanbul, Constantinople all over again. Right. Here's the Crusaders coming to the east, and here's the Muslims spreading Islam, and it's right in Constantinople again. So there we are. That's pretty cool. So yeah, you've got basically three ways to get oil to Europe: oil and natural gas. Right. You can go around, which they do, but it's expensive. You can go through the Suez Canal, which is the preferred way, or you can, as I think it was Britt said, get this pipeline finished here. Maybe it goes through like this. I don't know. Maybe it goes like that. I know that there's one pipeline that hits a point and goes north towards these guys. And apparently it's going to go north and they'll break branches off, but there's probably obviously another pipeline in here. So yeah, so that's it. So there's three ways to get oil to Europe. And you know what's going to happen? And I say this, if I'm a German company that depends on oil, the price of oil is going to go up in Europe, right? We're going to blow this up, literally or figuratively, right? This is going to happen and take time, but they're going to become more powerful, right? And we're going to stop selling the SPR. It's like, if I'm a German company, screw that. If I'm BASF, I'm moving to China. That's where the oil is. The oil's here. So yeah, I can see why this is all so important now, right? Maybe, you know what, maybe Israel is going to be really important, right? Let's see. Why am I spacing out? Where's Israel on this?
You can, it's just below Syria, so they're not listed, but that's why Syria is being destabilized too, because it's the
right, exactly. So Syria and Ukraine have that in common.
Yeah.
Right. Choke points. That's the word you used. So one of you said that. I think it was Randy. Choke point. Choke point for natural gas. Right. Exactly. That was the whole. Right. I remember someone saying to me, "How does ISIS make money in oil if they're on Syria and it's it doesn't have any oil?" It's like, well, that's because they're fucking. They control the pipelines right now. Yeah, exactly. All right, cool. All right, let me touch on very quickly because I'm getting exhausted here. Where am I? I want to close mouse, close that. All right, I'm going to touch on yield curve control very quickly. Okay, what is your first question?
How high is the 10-year going to go?
Right, that's the end question. No, who was it? Kevin?
Yeah. So
what's your first question?
Yeah. So, I mean, I don't think my knowledge is enough to create like a very great specific question, but
No, that's what I mean. Start wide and I'll narrow
Yeah.
it. Yeah, start wide.
So I've been reading, things about basically Japan's letting their yields rise is kind of dictating the rest of the West
Right.
yields.
Right,
And
exactly. Right.
I don't quite understand how that's the case. If you could explain it.
All right. That last statement there, so I'll give you the statement that I'm going to rephrase the statement that you said to try and put it in the whole, because I've been saying this as well. The Japanese bond market, not money markets, not Fed interest rates, the Japanese long-term bond has been, for the last 30 years, the leader in interest rate trends in the G7. With me so far?
Yep.
Okay. I'm not talking about the Fed lowers rates, they lower. I'm talking about wherever the long-term Japanese bond goes, yield-wise, the rest of the world follows. Does it match it? No. But does it go in that trend or that direction? Yes. So the example, that the empirical evidence of that is, over the last 30 years, China's been drastically fighting deflation. And because their deflation has been, if you want to look at it this way, in a bigger picture way, Japan's deflation has been exported to the world, right? They're very deflated, right? And we just kind of benefit from it. It kind of mitigates our inflation. They've been pushing their rates lower. So the lower their rates go to fight deflation, the lower our rates can go, right? So they let on the way down. That's a fact. The conjecture is now, if Japan's, and this is where I'll speak with confidence, and I'm 90% sure, but I'm not 100% sure. If Japan's rates were dropping, leading the rest of the world's rates down, and now Japan's rates are rising, whether they're letting it rise or not, doesn't matter. If Japan's rates are rising, then the rest of the world are going to rise along with it. Does that make sense?
It makes sense. Yep.
Okay, so what I just described to you is empirically backed conjecture. Nobody knows that the rest of the world's rates are going to rise. When I say rest, I mean rest of the G7, right? But historically, Japan led us into the deflation fight. It's logical, although not 100% guaranteed, that Japan leads us out of the inflation fight, or into the, however you say it, okay? So we can get into the mechanics of YCC and they're letting rates rise versus keeping rates down, what that means, but that's the concept. And so Japan has had the near crisis deflationary market since the 80s. The Japanese market was so big in the 80s. Like I remember the Japanese are going to buy Times Square, and it's like, they're going to whatever we're thinking about, whether it be Islam or Saudi Arabia or Russia or whoever's buying everything now. It was the Japanese are going to buy Hawaii back, but it was crazy. Like the real estate, I think the lunacy of it at the top of their market was the real estate surrounding the Imperial Palace, whatever that is, however big it is, had the same dollar value as the state of California. That's how crazy it was. Now, I don't know how big, but put it this way, California is as big as Japan, I think, So how big? So the yen was so fucking strong and their economy was so strong and they were just killing everyone. I mean, in a good way, like the world benefited from it. And then when it just went boom after the 80s, after 87, it was over. And they have been trying to not deflate ever since. And they have demographic problems. They're not an immigrant country. They're homogenous. They're conservative. And they're an island nation. So it's been very difficult for them. Kind of like that. Some of the similar problems to England, but one of them is culturally they're very different. So that's how this started. And after the 80s, Japan plummeted, like went to fucking zero. And they have been fighting ever since, and they fought it with QE, printing money, not just printing money, but printing money and buying their own bonds, forcing long-term bond interest rates to zero, NERP, ZERP. Remember that? negative. Why were they doing that? Because if you make interest rates zero, then people have no choice but to invest in stocks and the economy. Now, did it work? No. Did it help? Probably. So while they were doing that, we were like this. We're okay. We don't need to do that. But we can lower our rates too. Never got as low as theirs, but walked down with them. Now, Europe got as low as theirs because Europe just fucking went batty with it. So that's it. So that's QE. QE was we're buying bonds, we're pushing rates down. 2%, buy them all. 1%, buy them all. 0%, buy them all. It's not going above 0% ever again until we get this fixed. That's what Japan did. And so the rest of the world's like, well, okay, I guess we can go down to 2%. I guess we can go down, I'm simplifying, that's what happened, right? So on the way up, Japan's like, for whether their assessment of their risk is right or wrong, I don't know, but their risk is like, we have inflation, right? And I'm not going to get into the whole, I mean, I love to talk about the yield curve control thing because it's because nobody knows about it except for a small group of people like the bond guys at Zero Hedge and us that really understands it. But basically, the long-term yield on your bond is a reflection of inflation. So if inflation is high and your long-term yield is low, then people are getting robbed, right? You're giving them 2% and inflation is 10%. Then what happens is people say, I'm not going to leave my money in your bonds. I'm going to take my money out of your country. They convert the bonds to currency and then convert the currency out of yen into dollars. They get a higher yield somewhere else. It becomes a carry trade, right? That's what goes on, right? So if your long-term yields are too low relative to your inflation rate, your currency drops. Now, I don't want you to think about that right now because that's the result. So what happens is on the way up, the world's saying, Japan's got inflation. Forget about their own problems. Japan's got inflation. Let's sell the yen. Let's get out of the yen because they're yielding 0% and inflation is 2%. Let's get out of the yen and put it in German bunds. Let's get out. And so Japan's like, and so what happened was the Japanese are still saying rates are going to be zero. Rates are going to be zero. And the world's like, you guys are retarded. Excuse my French. You guys are stupid. Interest rates back there have to be 2%, or we're taking our money out of your country. To hell with your stocks. We're just taking it out of the whole country, right? So Japan's like 0%, 0%. The world's like, you know what? Sold your bonds, take the money and put it in something else. And that was a big carry trade, right? You shorted bonds to the government at 0% because they kept buying them at 0%. You took that money, you converted it into dollars yielding 5%, and you knew their currency wasn't going to go up because they were keeping the bonds artificially down so that's a carry trade, right? So that's what happened. It becomes a crowded carry trade. Then Japan says at some point, they say, you know what? Okay, our currency, and there's other manifestations that really make you stop doing that are related to your currency. I'm not going to touch on those, but they're not complicated. So the currency's getting a beating because the bonds are artificially, the rates are too low. So the currency's getting a beating. And by the way, Japan's like saying, the currency's weak. We'll sell more stuff that we make. We'll manufacture. They're going to export their way out of the economy, whatever. But that's not working. For whatever reason, not working. So Japan says, fuck, inflation's getting really bad. They go, all right, we're going to let interest rates go up to 50, half a percentage point. And they do that. The currency strengthens a little bit, right? And now the bonds go up and people are like, well, 50 basis points is more than zero, but it's still weak. And so they start buying. And so the market senses weakness. Oh, if they're letting it go up by 50 basis points, they'll let it go up by 100. They'll let it go up. Like they think the Japanese are finally going to pay the piper for their oppressive financial repression. So it goes to 50 basis points. Japanese cap it at 50 basis points. So they're still doing QE, but they're not pushing down. They're keeping from going up. So it's kind of like the glass is now half empty, right? So you got the Japanese at 50, and the yen is just. And at some point, inflation's not going away in Japan, right? And at some point, the yen goes, screw this. That's not enough. Inflation's really bad, and the U.S. is raising rates to 5% over there. I'm going to put my money in dollars. And so you see the yen get slaughtered again and again, right? And so Japan says, well, we have to let our long-term rates go higher, or the yen's going to, if the yen gets slaughtered too much, that's bad for reasons that we're not going to go into, but it's not that complicated, right? So Japan says, all right, now we'll raise it to 1%. And that's why in the article, if you read the broken bond ladder article, I've written about it a couple of times, but the broken bond ladder article describes how it works, right? It's like, it's like, but I mean, I'm describing it from a US point of view, but it's happening right now in Japan. So now Japan's like, we'll let it go to 1%, right? And when they let it go to 1%, and this is how it works. This is why other bonds got weaker. They let it go to 1% on the hope, this is where the whole zero hedge stuff comes in, on the hope that would let the yen strengthen, right? We're giving you a higher rate. It's getting closer to inflation. What's the panic? Leave your money in yen. Well, guess what? They fucking sold the yen again. Why? Because now they sense real weakness. Now they're like, good, inflation's like 3-4%. You're giving us 1%, you're giving us an inch, we want a yard now, right? So what happens is interest rates go up to 1%, test the boundary, the yen gets crushed. You're like, well, this is supposed to be fixing the yen. Well, it's not fixing the yen. You showed weakness, you blinked. And the bond vigilantes in Japan are going, we're out, right? Meanwhile, the rest of the world's going, wow. If the yen is that weak and they're only giving 1%, then they're going to raise rates more. And by the way, the US should raise rates even more. So Japan is leading us. They're not pushing rates up. They're letting rates float. But Japan is leading us out with higher rates remember, inflation is supposed to be discounted in your long-term bond. If you have an inflationary fear and you fight it with short-term interest rate hikes, that stops it, or slows it, but it will come back unless you give people an enticement to buy a 30-year bond at 5%. Because to buy a money market at 5%, that's fine. But what happens when the Fed lowers rates again? What are you going to buy, a 30-year bond at 1%? You're not going to do that. And inflation comes right back. You start putting your money in stocks, you start putting money in your commodities, because your long-term capital investment market is broken. So you have to let the long bond yield go up. And in doing that, you attract long-term money. Oh, I can get 5% money? Yeah, I'll leave that in your country for 10 years. And when that happens, when your broken bond ladder goes like this, it goes fighting inflation. This is how a normal market works. Here's your short term and here's your 30-year, right? We have inflation. We have inflation because interest rates here are lower than the inflationary rate. But the inflation is not 30-year inflation, it's 6-month inflation. So you go like this, you raise rates, right? And what happens is, at first, the long bond rate goes up because it's like, oh, if rates are going up here, they should go up there. But then you raise rates again, and eventually what happens is, in a healthy market, the long bond goes like this. Because the long bond's saying, this interest rate here is fighting inflation. In the long run, we're not going to have inflation. In the short run, we're fighting it. And then the Fed lowers rates, and in a healthy market, it goes like this. The back doesn't move and the front drops below. So you got this. Here's your market. Higher, higher, higher. It's like a tail on a dog. Higher, lower, lower, lower. So this gives you a healthy yield that buffets or buffers the pain of inflation. Well, we're at zero, right? We're at zero. So now you've got this. Now you've got 5% here, 0% there. It's too steep. That's where the inversion gets too steep. It's too steep. So we have, if inflation is short term and it's transitory, then when they lower rates, the bond market back here should be normal. But it's not transitory. It's supply chains. We don't have enough houses where they're supposed to be. We don't have enough goods. We've got to reshore. We've got to rearm. So when you drop the 5% yield, this is going to go up because the inflation is still there. It's just got to migrate out. Now, how do you assess that? You assess that, or how the Fed is assessing it, not me. I don't. They look at it like we're looking at real rates. Real rates are 2% now. Real rates are 2% in the 10-year, but are they 2% in the 2-month? You need real rates in the short term. I'm not saying you need it. The Fed's looking at it that way. The Fed is happy that real rates in the long term have gotten positive. That's healthy for our bonds long term. The Fed is not happy that real rates in the short term are still not positive, meaning inflation is 5%, interest rates are 5%. You follow? So they want inflation to be 3%, interest rates 5%, and then they'll lower. So what's happened is Japan, 30 years of deflation, 30 years of inflation. Who the hell knows what's going to happen there? They have to keep letting it go up. So it's a controlled demolition of the Japanese bond market, which makes everyone else fight it. Very long version. Does that help?
Thank you. That was
I didn't hear
great.
you at all.
That was great. Thank you so much.
Good, good. I'm glad. That's yeah, yield curve control is fascinating because in the end, yield curve control is how they the market's going to discount inflation one way or the other. And if you don't let inflation eat away, if you don't let prices go up, then supply goes down. So if you fix the price of an apple at 50 cents, but apples are $2 elsewhere, then all your apples are gone. They're going to go out, right? Okay, so if you fix the interest rate at 50 basis points and all the other interest rates are 2% over there, all the money is gone. You leave and go to where the money's better. You leave and go to the higher price in apples. Same concept. And that's it. And by the way, financial repression, yield curve control, what it does is international money sees it, pulls their money out, and goes to other countries. Now, we're not doing that yet. Domestic money that can't get international access will say, oh my God, I'm getting 3% in a CD, but inflation is 8%, or whatever it is, a 10-year bond. They go, I can either put my money there and lock it up and suffer because I got to work harder, my standard of living goes down, or I can take the money out and put in stocks and hope that stocks go up to fight inflation. But if you get stagflation, you're dead. Okay, so that's the whole problem. Yield curve control punishes domestic people while the rest of the world is taking their money out of dollars and putting it into something else. Maybe it's a BRICS gold-backed currency. Who the hell knows, right? While the rest of the world is doing that, you and me, lower class, lower middle class. I hate that stigmatism, but you get my point. Socioeconomically, people that are struggling or just barely making it, they don't see what I'm talking about. They don't have access to the knowledge, let alone the products. We don't have access to we barely have access to the products, right? They're just going to be like, I don't get it. I don't get it. And what happens is you've got middle-class people who, this is like my pet peeve, middle-class people who don't get it, but who work their asses off and they get punished. That's when the middle class inflation, the middle class slowly slips into food stamps, EBT cards, underemployed, they get fired. They get fired, they're working harder, they get fired. We're in a stagflationary environment, inflation is there, and my parents get screwed. That's what happened. And it's happening again. But it's happening to a different industry. That's why I hate financial repression, because it's the government lying about inflation and taking it out on the sheep who don't understand and punishing them for their fucking mistakes. Anyway, that's it. All right. Thanks for listening to the rant. Let's put it that way. This is Kevin's fault, by the way.
That's good, and I liked your piece on your family's history. That was great too.
Yeah, I mean that thank you, I appreciate it. That's what I'm talking about. Like, you got the other end of that. That's what I'm talking about, man. Like, they don't look, I got into finance because I saw factory workers getting laid off. I saw small businesses that service neighborhoods where factories were going under. I saw people that could afford to leave. I don't know why I saw this at a young age. I got lucky. But my parents were let me stop recording. This'll